Pankaj Murarka and find out what he's making of the markets right now. Pankaj, hi, morning. Good to be speaking with you as always. A show of resilience, at least for the past 2 days. Seems like all the negative was already done with all through July. We've had a consistent FII selling. The index alone has, I think, lost about 900 odd points or so. Do you think the worst is behind us, Pankaj?
Morning, Aisha. Always a pleasure talking to you. I think so. For the time being, it looks like that some of these bad news is in the price. I think directionally we are still very much in a bull market. So any fall, to my mind, is a correction in the larger bull market. I still think that index can do about 12-13% CAGR returns this year and probably over the next 2 to 3 years. And in that context, I think probably first quarter numbers have been pretty much okay. The good thing is that we've arrested the earnings downgrade cycle, and now incrementally earnings have stabilized. So probably, hopefully, in the second half of the year, we should see a improvement in earnings going ahead. There's been a fair bit of monetary and fiscal stimulus that has been injected into the economy in the budget through tax cuts and then by RBI with a front-load 50 basis points rate cut. Combination of all of that, I'm looking forward to a much better economy in the second half of the year and an uplift in earnings growth. So I would think that market should find floor somewhere around these levels over the next few weeks.
Quite interesting you say that, Pankaj, because for everyone that we've been chatting with, the biggest concern is that, there is no big positive dhamaka in the earnings, and in, pockets they're still very soft. So let's talk about earnings. What do you think is going to lead the recovery first? And would it be more consumer-facing sectors because they also are working with a low base?
True, but before that, let me just put the aggregate picture in place. See, last year we had probably one of the slowest earnings growth in the last 5 years post-COVID at 5% for Nifty 50 index. The earnings growth for top 200 companies was not very different at about 7%. So probably one of the slowest earnings growth in the last 5 years. Well, we'll see some improvement in earnings this year, but I must concede that the earnings growth this year will not be very significant. So if we can do a low double-digit kind of a 10% growth on the Nifty index for Nifty index companies, I think that will not be a bad outcome. I think probably next year is when we get into mid-teens kind of earnings growth. So I think it will be more a gradual recovery cycle, both on the economy and earnings. That's the one point I wanted to say. Obviously, you're right. That there is a skew in terms of earnings. So I still think that financials are coming off a low base. So probably, and given the fact that the margins have been impacted in the first quarter and probably first half because of the front load rate cuts by RBI, probably second half of the year we should see earnings recovery in financials. So that should lead. And I agree with you, Aisha. Probably consumers, we are coming out of almost 2.5 years of consumer slowdown. So probably second half of the year, we should see an improvement in earnings trajectory for consumers as well.
All right. Hi, Pankaj. Morning. This is Shrishti also joining in. But the bigger concern remains to be what happens with respect to the tariff. And Pankaj, in this uncertain time, have you spotted any sectors which you believe will be insulated with respect to the tariff tantrum? You just talked about consumption, and that remains to be a domestic play. But any other sector where you believe that there could be less impact of the tariff and maybe it's the time to shift into those sectors?
Yeah, it's a pretty unwelcome move in terms of the tariffs that we end up facing. But I still think that those are transitory and eventually these are all bargaining tactics. Eventually India and US will have a deal in place. Now, whether that happens in 8 weeks or 12 weeks is anybody's guess. I still think that the long-term effective tariffs on India will be much lower than what has been proposed. Having said that, tariff will have some impact, especially on highly export-dependent sectors like textiles, gems and jewelries, and few others. On the aggregate growth basis, I still think the aggregate negative headwind that will emerge out of tariff for the economy is still moderate and manageable. So probably a 30-40 basis points hit on the aggregate GDP, and despite tariff headwinds, India can still do a 6.2-6.3% growth this year, which is similar to what we did last year at 6.5%. So at the aggregate level, I still think tariffs is not a big headwind for the economy as a whole. as you rightly said, I think consumption will be one of those pockets, given that complete domestic orientation will remain insulated from it. I think in an environment where economic growth, there's a all of us have to consider there's a downward reset in terms of economic momentum from what we saw post-COVID. So in an environment where economic growth is moderated and earnings have slowed down, obviously there are pockets of markets where you can see high growth. And I go back to my my favorite sector, the internet sector. I think that's the sector where we are seeing growth still at 25-30% kind of a thing. And I think that sector, companies at least, many companies in that sector can sustain growth which can be like 2x or 3x of the underlying growth, underlying nominal GDP growth. So probably that remains one of my preferred plays of finding high growth companies in a otherwise in an economy and a market where there is earnings slowdown otherwise.
Right. So Pankaj, let's take that conversation forward. You've always been a fan of tech, and I'm not saying IT, I'm saying tech here. A lot of digital platforms are combining their might and strength with consumer-facing industries. Anything that's looking interesting to you there?
Well, a lot of them, we own Paytm, so I continue to remain a long-term constructive or positive on Paytm as a growth story. We like the food delivery companies, and now that industry is an oligopoly. Food delivery as an industry or segment, whatever we call it, will is already in a few years' time will be $1 billion cash flow, and oligopoly where 80% or actually the top two players will control 120% of the profits because the other players will keep losing money. And it will remain an oligopoly structure forever. I think the quick commerce is very quickly getting into an oligopoly structure where we'll have 3 or 4 players who will eventually dominate and control again 120% of the industry profit because all the other players will keep bleeding. So the good thing about this internet businesses that we like is apart from fast growth, because of the fast growth, they are driving industry consolidation in the segment in which they are operating at a very rapid scale, which effectively, when you have few players, it brings pricing power and it gives you a long runway for profit pool to keep growing. And I think that is one thing, unlike traditional industries, let's say a steel or a cement, where you still have cement companies in India, you have so many steel companies in India, and it's a global commodity. Here, you just have few players in every segment, and they will continue to dominate that space for a long period of time. So companies, the point I'm going to say is every segment, companies which emerge as leaders are the ones which we like, because I think they will have they will dominate the profit pool and they'll have a long runway of cash flows over the next 15-20 years.
But for now, you think, Pankaj, I mean, if someone doesn't want to buy both and buy one, either Eternal or Swiggy, you think valuation comfort is more with Swiggy right now? And would you even pay 300 for Eternal?
Both, Aisha. Now it's every investor's call in terms of what they like, and as they say, valuation after a point of time is a matter of judgment because there are too many variables going into it. But I think if you ask me, over a period of 5 years, both of them will do well.
All right, but Pankaj, the other pocket that you were very bullish on is the banking space. We have talked about it in the past as well. But now, Pankaj, given the fact that we are in the rate cut environment and even the banking companies are talking about the NIMS compression going ahead, what's your sense on the banking space right now? And you continue to hold HDFC, Kotak and ICICI Bank. Any other banking name that is looking good to you, or any of your recent additions rather?
So, Srishti, the view on banks remains positive. I think NIM compression is a transitory thing and it's a cyclical thing. Whenever we will have rate cuts, obviously the way the sector regulations or RBI has regulated the sector, your assets gets repriced much faster than your liabilities because your liabilities are long duration. So this is a cyclical thing that in a rate cut environment, banks will have some NIM compression and in a rising rate environment, they will get benefit of expansion in NIM. So I don't think so that's something we should be concerned about. What we really like is banks with strong liability franchise and pristine asset quality. And it's very clear now that the larger banks have an advantage over smaller banks. So clearly we like the larger banks. In fact, we own 4 of the top 5 large banks now in our portfolios, including HDFC, ICICI, Kotak, and State Bank. So that primarily reflects our view. One thing which has been holding back the sector, apart from the cyclical issues of NIMs compression, is slower loan growth. And I think probably as the economy recovers in the second half of the year, probably we'll see recovery in loan growth as well in banks. More importantly, I think this in a market which is priced to perfection, and there are a lot of sectors in the markets where valuations are far ahead of fundamentals. This is one sector where I think valuations are very reasonable. So I still think these large banks can do for an investor having a 3-year time horizon, they can do a high teens kind of returns or earnings growth, because in an environment where credit will grow low double digit, these banks will take market share from smaller players. So they will go ahead of the industry credit growth. So effectively, they can do mid-teens kind of credit growth and mid-teens to high-teens kind of earnings growth. And those kind of shareholder returns are possible, high-teens kind of returns in these banks over a medium-term time horizon.
Post this earnings season, Pankaj, are there also pockets where you're convinced that you need to avoid them or do away with from your current core list?
What we're clearly doing, just to keep things in context, before I say that, Aisha, we need to understand this, that India is the most expensive equity market in the world. And in the most expensive equity market in the world, we are in the 6th year of a ferocious bull market. So obviously, at the broad aggregate index level, markets are priced to perfection. And there are pockets of markets where obviously valuations are expensive or stocks are far ahead of fundamentals. What we've clearly done in our portfolio is we have taken the valuation risk out of our portfolio. So whichever segments of the markets where we think valuations are far ahead of fundamentals, we have clearly taken money off the table. So for instance, we exited all our defense exposures. We're happy to take money off the table because in the last 3 years, 5 years, it's been pretty rewarding owning some of these stocks. But now these stocks are pricing in high 20s, 30s kind of earnings growth for these companies over the next 10 years. Well, there's earnings visibility in terms of the next 2 years, but I'm not sure over the next 10 years whether these companies can do that kind of earnings growth. So obviously there is a lot of expectations built into these sectors, and I still doubt the long-term earnings growth can be sustained at what market is pricing in. So we've clearly, meaning what we've done is logically we've taken, if you look at the entire market, the top 20% of the market, which is most expensive, we've taken that out of our portfolio, and which includes defense and some of the other companies across electronic manufacturing and those segments. Because we want our portfolios to be reasonably priced, and at this point at a mature stage of economic cycle and bull market, we don't want to carry valuation risk in our portfolios.
That's quite interesting, Pankaj, and I think you're one of the first ones to actually come out and say that on national television about, spaces that you think are overvalued. One didn't think all those are going to make it to the list, but always good chatting with you.
Thank you, Aisha.
Okay, let's just revisit where the market is settled in at. A show of resilience for sure.